Simon, an emerging trend, around representations and warranties is the use of rep and warranty insurance to protect against losses arising due to any potential breaches that the seller might have in their representations. Can you talk about the use of reps and warranties in the UK?
Yes, it's something probably at least on maybe 50% of deals that we see now. And especially in secondary buyouts, management buyouts. So the management team are rolling money into a new private equity-backed business. But the previous private equity house isn't prepared to stand behind any of the warranties because they don't manage the business and they don't want to take that risk of having money claimed from them. So management teams want to be covered. They want to be in the same position as a private equity house. So we quite often see management teams, they have a liability of £1 or $1 in the agreement, and then the insurance will cover them for probably 90% of the warranties that they're giving. So certainly not in terms of their right to ownership of the shares, that's normally carved out. And there will be some specific indemnities that may be carved out, especially around maybe environmental is one area that's sometimes more difficult to get covered. But the idea is then that the warranties and indemnities can be quite full. The insurance company will then review the legal agreement. They will also review the due diligence because they want to make sure that a thorough due diligence exercise has been performed by the buyer and that it's covered all the key areas. And in that way, they can get a sense of how serious the buyer has taken the due diligence. They don't want the buyer to think, well, I'm covered on the insurance, therefore I don't need to spend as much money on due diligence. They still want the buyer to go through that full exercise. And off the back of that, they will then be content to give that insurance. And we find that it tends to cost about 1 to 1.25% in terms of the amount you want covered. And it quite often the buyer will only want, it might only be 25% of the purchase price covered. So they're buying something for £40 million, they may only have £10 million of cover because it's very unlikely that you've got a claim that you're going to be claiming for the full 40 million. So at least that gives them a certain amount in terms of claims coverage. That does act as a good insurance policy in that way.
Mm-hmm. And there's usually minimum kind of policy premiums, so it really excludes smaller deals from getting reps and warranty insurance. Do you find that as well, or?
Yes, I mean, I guess it does tend to be on the larger transactions. And certainly if it's a secondary management buyout, it tends to be a fairly mature business. And we do have, deals where the management team, we just sold a business to a US buyer and the management team didn't see the point because they understood the business and they were happy to stand behind the risks. They owned 80% of the business and they were more than happy to stand their corner, if you like, and didn't feel the need for the insurance. We even had one last year selling to a US quoted company where they went through all the, they paid the broking fee or the underwriting fee on the insurance, which was, a small sum of maybe £25,000. But they decided not to pay the premium of $140,000 because having gone through all the insurance-backed exercise, actually, they were pretty convinced that they had done a really, really thorough job on the due diligence, and actually they just knocked that money off the purchase price rather than getting the seller to pay for that.
Bill, what's your experience with reps and warranty insurance in the U.S.?
Yeah, that's been something that's developed in the last few years. A few years ago, we didn't see much of it. I can remember bumping into different insurance brokers I know, and they would talk about it. And it was typically for larger transactions, and we're starting to see that filter down where the pricing has come down. It can make sense for some of the smaller transactions. And the benefit that we're seeing, yes, there's a premium that needs to be paid to cover for this insurance product. But what happens is the amount of money that goes into escrow comes down. So instead of 10% or maybe more being put into escrow, it's maybe half a percentage that is going into escrow. And so the seller, yes, you might have to pay premium, or maybe you split that with the buyer. That's to be negotiated. But the benefit is that you get more of the proceeds at close. There's less money that goes into escrow.
Mm-hmm. Michael, you want to share your experience with reps and warranty insurance?
We've been working with reps and warranty insurance for some time. Our clients have hated putting 8 to 10% of the purchase price in escrow, and so where we have a clean company that's large enough, where the buyer is doing really high quality due diligence, it's sensational. It's a win-win. We also get people to share the cost, so it ends up being really de minimis. So it's really something that I would strongly encourage. Just to be clear on the percentage, so if the escrow is supposed to be 10%, reps and warranty insurance usually brings it down to 1%, so they can, in a $100 million deal, that's $9 million that they can be putting in their pocket and investing. So it's a quite attractive. There is another player at the table doing due diligence, and so you just if timing is critical, it's by definition going to add a little more time.
Yeah, definitely benefits to it.
Yeah, and I think also it's interesting noting that in the UK, there's not a track record of escrow. So we would not have an escrow account in probably 90% of deals. So there's not the same trade-off, if you like, for reps and warranty insurance, because you're not getting more money out. It's only if we sell to a US corporate where we would expect, or even a continental buyer, the cross-border transactions do tend to have escrow. But when it's a UK domestic deal, we never have escrow. And I say never. On some deals we do, but it tends to be there's 30 shareholders, and the buyer doesn't want to try and track down every shareholder. But where it's just usually 3 or 4 shareholders, there would never be an escrow.
Yeah, I mean, definitely shows the benefits of that reduction of escrow in the U.S. and then interesting on maybe the difference around escrow in the UK.